This paper is joint with Vikas and a couple of others. One is Pulak Ghosh at IIM Bangalore, and one is Haibei Zhao at Lehigh University. Let me get to the business right away. Closer? Okay. So we have retail investors are jumping into options all over the world, and so there are a number of statistics that speak to these things. US options, it's up by 80%, and worldwide options, you have about a 5x increase in retail. And, there are a number of articles, if you look in Bloomberg and other financial press, which keep speaking about the jump in options trading. So what are the concerns that arise when options become so widespread? So one is that, one is the good thing, which is that you give options to investors and they can do good things with the options. They can diversify, hedge, take appropriate risks, and what have you. So that's one possibility. The other side is that options are relatively sophisticated contracts or relatively simple contracts that can induce speculative behavior. And one question is whether these are suitable for retail investors. So we provide some of the evidence on this based on the Indian options market. Now, why the Indian options market? And this may come as a surprise to many of you, but the Indian options market has, by many measures, including in US dollars, the largest market in the world by a long distance. 80% of the number of options traded in financial markets are there in India. So this is sort of very, very striking, especially because until 2016, India was the country with the largest number of excluded financial individuals. I mean, people didn't even have bank accounts. There are little villages where they store cash. India has historically bought Indians buy gold for savings, and there are a lot of other metrics that you can think of. And so it's quite surprising that the options have been big, and options have been big for a long time in India. So we have some unique data to say something about options. So first, we have all options trades in India. Every single financial stock option trade is there in our data set. We can follow individuals over time. And so we don't know who the person is. I don't know what I traded from my own data set, but we can track every individual. The data comes with one at a daily level. Every day I know what you have bought, what you have sold, how much money you have made out of that. And at the end of the day, I don't observe every tick that you're trading in specific, to be more specific, but end of day I have everything. And India is actually a very fascinating country for one important reason, that natural experiments, which are the flavor of economics, where things change and then you can observe what people do. There's one happening every minute in India. So there are three important natural experiments that we catch in this, and they speak to about the reasons why people trade options and what they do about it. So that sort of sets up the presentation. So we'll give you some descriptive statistics, and that'll take up a while in the paper. And then after that, we'll talk about what do individuals actually do. One of the striking things that you can find is that index options trading dominates in India. Like 3/4 of people are just trading index options. So that's one interesting thing, not individual options. The second thing you find is people have very, very short horizons. 80% of the volume, 70% of the volume, you pick your year, is intraday trading, meaning that people get in and get out by the end of the day. And the remaining part of it, some people hold for the rest of the time, but these positions tend to be simple. They don't hedge any underlying. They just either buying calls, selling calls, buying puts, selling puts. The number of complicated trades which involve buy this, sell that, and create butterfly spreads, all that is not there in the data. First order. Then you see fintech brokers jumping into India, like everywhere else, and by that I mean these Robinhood kinds of things. They're there in India also. And what do these guys do? And what you find is not very positive. That they encourage the speculative tendencies, and people seem to lose when they trade out of with the fintech brokers, including in funny tests in which we can track one person making the same trade through a non-fintech broker and the fintech broker, and the fintech broker turns out to be worse. So this is what you see. Retail traders in India lose a lot of money, plenty of money, and they accumulate. And what you find out here is interesting, two experiments. One is that you introduce weekly options. Usually you had like in the US, monthly expiration cycles. Somewhere some guy woke up and said that let's try to do weeklies for Indian options. And you find that the speculative volume in weeklies jumps. And people lose more money, not make more money. Then we have other things that the regulators then got into the act and said that let's try to curb the speculation. So what they try to do is they tighten the lot size. They increase the lot size significantly in India, saying that the minimum lot size has to be big. Then they introduced delivery margins for in-the-money options. You actually need to hold cash. And so both of these changes, what happened is that they tried to curb the speculation. And what we notice over here is that speculation came down a little bit, but that it is offset by shifting in speculation. So what you start doing at that point is you buy whatever you can afford. So you don't kick the habit, right? You are addicted to cigarettes or something, you know, somebody bans one brand of cigarettes, you switch to something cheaper. Or if you are in India, you buy something called BDs, which are very cheap. So that is basically what you find out here. So that is basically a nutshell of what we are going to talk about. The rest of the paper is basically sketching out in proper detail, you know, what we are doing. So what is the related work? I'm going to quickly go past it, but this slide I wanted to say something. Financial inclusion has been a big theme going around the world. World Bank has things saying everybody should be financially included in the world. People need bank accounts. People need to transfer money with mobile phones and so on. Now, everything is great about it. And in the financial market inclusion, what it does is it allows you to invest in the stock market, gain some of the risk premium that we know exists in the stock market, and it allows you to diversify your portfolios so you don't have to hold gold, you know, don't need to bury currency notes under your hut and things like that. And so people said that this has got to be a good thing. So one of the things, this is probably correct, but one of the costs of financial inclusion is introducing sophisticated, unsuitable products to investors not prepared for it. And we see some of the downsides. One of the other things is, which is a kind of a more subtle point, is that once you begin to get into financial markets and speculate, speculation becomes a habit and it becomes hard to kick. So you try to start speculating and try and stop it and say that this is not good for you. You shift to something else. Now in our paper, it's interesting because people lose money. Normally you think that after losing money, you kick the speculative habit, but no, it sticks around with you for a little longer. So that is the sort of what we find out here. There's a plenty of other work on retail options trading. There are a few features of our paper that make it unique. Primarily the data set is rich and it's panel and it encompasses the whole market. So we see everything. There's work on gambling and lottery preferences. One of the things I wanted to point out, and a lot of literature and very nice papers on this, which point out that people invest in low price stocks and things like that, which give them speculative opportunities. That is correct. But one of the overlooked points out here is that options give you as much of the speculative kick as stocks do. One second, let me go back again. So options give you as much of a kick in terms of skewness, and options have some advantages. If you buy a one-day option, 0 day to expiry, you kind of know whether you're making money or not, how much money you're making, how much money you could be losing in the day, and you're done. They are simple contracts, they are short horizons, and they resolve at a fixed date. Whereas you buy one of these stocks, you know, NVIDIA is not quite a lottery stock, but if you bought NVIDIA, you don't know when the chip business is going to boom, when it's going to come together, where it's going to stop. Is 4 trillion enough? Is 8 trillion enough? Is 20 trillion enough? I don't know. And I don't know when I'm going to realize all these payoffs with tariffs and other things playing around. In options, I know everything. I do a bet, it resolves itself quickly. And then you can sort of do some math out here to show it. And investors seem to appreciate this fact because option volumes are much, much more than the business that people do in lottery type stocks. So this is the data. So there are a couple of things that we do in the data, and then I'll get to the results. We kind of throw out traders which have very less volume. 5,000 rupees is almost nothing. It would be like something like $50 or something like that. And we exclude some guys called pro-tail traders who are very right side outliers. They trade a lot. They seem to be people who are institutions or have been in institutions and that kind of profile. The rest of it is our population. And just for context, we are talking of millions of people in our data set. So this is the growth in retail trades, and you can see what is going on. We have 15x growth in retail trades. We have 53 times the growth in contract numbers. So each person is also trading more. We have 86 times growth in premium turnover. This is more because Indian stock market has been booming like many other stock markets. So the actual, the dollar amounts increase. And then the notional amounts, which is the amount of the underlying, is also increasing by big amounts. So you see the growth over here. The growth is exponential towards the end. And one of the things you notice, and I don't have any causal statement to make, but it's a very strong correlation, is that is the time India started on the path of digital financial inclusion. They had a program that gave bank accounts to everybody. They automated KYC procedures. Everything was simplified, so I could walk in and do everything with something called an Aadhaar card, where you press a fingerprint and you get verified, and you can open your bank account. So that coincides with this part of the boom period. But it also, subsequently, there have been the COVID pandemic and other things. So there are a lot of other things going on, but these are all coincident and starting around the digital financial inclusion in India. These are the losses. So this is the loss pattern. You can see that the losses, cumulative losses keep on heading down. That is one feature. People lose a lot of money. It's about 1 lakh rupees. That is what it is, which is, how much is it? About $1,000, something like that. That is the number. It's comparable to an annual GDP level, roughly. That is what people have lost. The trading profits, you can see that most of the losses are concentrated in the small traders, not in the big traders. They are the unsophisticated guys who lose the most. The other remarkable thing is concentration in index options. The invisible lines that are below are individual stocks, and you can see all the growth is in index options only. So people bet only on the stock market index. There are two popular stock market indexes that they bet on, and we'll come to that in just a moment over here. So one question you can ask is, why index options? So one of the things, there are a lot of variety of them. You have a lot of maturities, a lot of strikes, and they're very liquid. So people seem to like to bet on individual stock options for a long period of time. And in our data set, on average, you have about 513 index options that you can play around with in a couple of indexes. And there are about 49 individual options on average. Short-termism. So day trading volume, you can look at the percentage of day trading volume. It's trending up. It's about 80%, 70%. You pick your favorite number in that region. So that is sort of concentrated. Where does day trading concentrate? Trading concentrates in short maturity options. And actually, zero DT, that is 0 days to expiration, 1 day to expiration, is dominant. Everybody likes it. The general pattern that you see is that people like to bet on options that are at the money or slightly out of the money, not more than that, because in the money you lose some amount of skewness and you have to pay more. Out of the money, they're a little bit cheaper, and there's some short that you can make money in the short maturity remaining period. So that is sort of characteristic of this behavior. And people seem to like to speculate on what they can afford. So that is one of the observations. Well, how long do people trade in options? So the way we calculate it is very conservatively. Look at the first day in which you enter a contract. Remember, these are monthly contracts and they keep changing. So I count the first day in which somebody gets in, and then I count the last day that the person trades that contract. And if there's no last day, the contract expires. So we kill it. So what is the average date? The median is 0 days, which means the average person in India is a day trader, and the mean is 2.4 days. And you see the volume kind of spikes towards the expiration date. That is one part of the interesting thing. The more interesting is who is trading these options close to maturity. And in our sample, it is dominated by new traders who have not touched the contract before. They jump in on the last day. So it's a very, very strong observation across the period. Now we'll just move on over here. So this is a simple thing that we looked at a simulation in our sample in one of the indexes. What is the skewness you would get if you just bought the underlying? It's not very much. It's not significant. This is the bottom line out here. And what is the skewness that you would get if you played on the options on the same underlying? And you can see the numbers over here. They are kind of multiplicative by 5 times, 14 times. And this is based on the realized returns in our sample in India. And so you just get huge bang for the buck in terms of skewness. There's some variation based on maturity, time to maturity, how much out of the money is the option is, but basically it's a big number, by any stretch. Then you look at the trade duration. So you find that the trades usually begin in India about 5 days before expiry, and then they peak at 0 days to expiry. That's sort of the general pattern. But before 2016, the 3+ day, meaning 3, 4, 5 days typically, was dominant. After the 2016, which is when the inclusion started, the median numbers switched down to 2.5 and to 0. The median then becomes 0, which means everybody was a day trader at that point. And this is the time also when a lot of people got into the market. So it tells you that the new people are basically speculators and day traders in this. So we get all of these things. We looked at the open positions that people who don't do day trading, what do they do? Essentially, the big chunk over here, 80% of them, all of them are either holding calls or puts. They have either written or bought one of these two things. They're not doing anything more complicated, which is very, very small portion of the deal. So this is clearly and completely, it seems to be a speculative gambling type of behavior that you see in the data. So this is the summary. So what we have just said. So we'll just move on to the natural experiments. And I just want to make sure, because time, 5-10 minutes? 5 minutes left. So I'll get to the 3 natural experiments, and then I won't be able to cover the rest of it. So I'll just discuss these things. So the first natural experiment is introduction of weekly options on the Bank Nifty index. Now let me explain what this Bank Nifty is. In India, there are 2 indexes, which I'll come to it. One is called the Nifty 50, which is a normal large cap index consisting of 50 stocks. The Bank Nifty is a different creature. It has 12 banks. Some of them are private and some of them are state-owned. In India, the state-owned banks, the government banks also have publicly traded shares. So those prices, and they construct an index out of it. Both of them, before 2016, have 1 expiry per month. This is typically the last Thursday of the month. In 2016, what did they do? They introduced Thursday weeklies for the Bank Nifty. So now we have, for Bank Nifty, every Thursday there's 1 expiry. For Nifty 50, you continue to have 1 Thursday in a month. So that is sort of the experiment we have. Now what do we see out here? See the flat line below. We didn't have weeklies for Bank Nifties, so there's 0. And see what happens once you introduce weeklies. The Bank Nifties take off and they actually exceed the volumes within 1 month. They exceed the notional amount of the Nifty 50. And within 3 months, they overtake even the premium volume of the Nifty 50. So the weeklies induce, huge amounts of speculative trading instantly over here. And before then, all the other contracts you see, nothing much is happening. The lines are essentially flat. And just the weekly Nifties is what, lifts off over here. So who jumped into the weeklies? And you find that 68% of weekly traders had no experience trading the Bank Nifty at all. So they're entirely new. And 46% of the weekly traders, which is even more remarkable, never traded options before. So once you see weeklies, they plunge into it and they start playing around with it. Intensive margin. So you also see that the people who were trading in options anyway, they increase the amount of options that they're trading. And there's some numbers over here. So the weekly shift, short maturity, it induced speculation. And this kind of a nice result, because now you see the maximum volume in the US is in 0 days to expiry. So this is a natural experiment which shows that there's a supply side effect, that you give this and people will jump into it. It's not just people having latent demand and being satisfied. There's a supply side interventions do it. What happens to stock investments when you do this type of behavior? What you find over here is that the tendency to purchase stock comes down at that point. So people are shifting out of stock into options once these weekly short terms are introduced. And the second experiment is lot size increased. Basically what they did is they doubled the lot size for Bank Nifty, 15 minimum contracts you have to buy to 30, and they tripled it for Nifty, which is the other index that was available. And the change in price is enormous. It's a substantial barrier. So now let's see what we do, what happens when you do that. So the treated guys are always below the new limit, and the control guys were always above. So let's see what happens to the new guys who are subject to suddenly these restrictions on what they can trade. And so what you find is interesting enough that once the lot size rule is imposed, trading comes down. That's a good news over here. And now this one basically says that this one kind of makes the other point that once you once you increase the lot size, people shift into cheaper things. Now what is cheaper? Cheaper is 0 days to expiry. So people cut down on the maturity to save money. So that's what you see. Then second thing is out of the money options. People switch into out of the money options. And you see these patterns in various ways over here. This is the 0 day phenomenon, the spike here. And within each one of them is the moneyness. And you find the spike is mostly in out of the money options. So you have good intentions of shutting down speculations, but what you observe in response is a speculation shift into whatever you can afford. And this is the point about being addicted to speculation in options. Once a habit set in, it's very difficult to do it. So this is the regressions that say the same thing, but I'm going to skip it. We don't have time. The second thing is settlement margins. The Indian stock market regulator, which is SEBI, it is like the SEC in the US. It said that you need physical settlement for in the money options, and they did it only for individual options. So for this test, I'm going to a different data set on individual options, not the index options data set. You can't really require physical settlement for index because there's like 12 of these stocks and 50 in the case of Nifty. It's a mess. What are you going to deliver? How you're going to deliver? So these guys pay, the holders of in the money options face sudden spikes in demands for their capital. So what do you think they do is the question, and we address that issue. So this is an example of what the brokers did. They don't want 100% of the stock, but they have a significant percentage of the stock. And basically one broker, which is a fintech broker, demanded 10% of the underlying stock as margin on if it's 4 days, and that increases to 70% as you approach 0 days. So that's, the number is very big. So for one Black-Scholes value of 230, the margins demanded would be 980 to 6,860. So the demands on margins capital are enormous over here. So then what do you see? You kind of see that you see the reduction in trading of in the money options because you have to shell out capital to hold. So what do you see instead? You see a spike in the out of the money options. So you can question whether this is a more suitable or less suitable product, but you see immediately this shift also. The point is not to say this is optimal or not, but it sort of makes the point that speculative habits, once they're entrenched, they're hard to break. That is it. So I think I'm going to stop there because this is pretty much all that we have here. I just want to stay on time and we will go to the conclusions of this. No, I don't want this. So we study retail trader participation in India, the biggest options market. It grows quickly. It concentrates on index options. Traders are short term. Most of it is day trading. Some of it is simple positions that are left open. The volumes spike exponentially as you get to 0 days to expiry. And 3 experiments basically show that people, when confronted with barriers to speculation, don't stop it. They move elsewhere to speculate. So that's sort of here. And then the bigger picture, bottom line is that when you have financial market inclusion at this pace, in India, a few 100 million people were brought into the market from basically 5 million. The expansion was big. That they also entrenched some kind of speculative habits, and it's a challenge to undo them. So a little, I would say that a glide path is necessary for financial inclusion. Thank you.
Thank you.